Hi there, tax accountants. I hope all is well. And I pray that as you are viewing this video, that you're in the best of health and spirit. This video will cover several questions from Chapter 8, which deals with consolidated tax returns for corporations. So we'll jump right in and start off with the first question. It states, select either yes or no to indicate which of the following events may have occurred involving large corporation that triggered the availability of the consolidation election. In working as the tax consultant for Large Co., Megan discovers that for the first time, the corporation is eligible to form a consolidated group for its federal corporate income tax returns. So, in general, as we learned in Chapter 8, the IRS allows certain corporate groups to be treated as a single entity for federal income tax purposes. And although there's some non-tax concerns that may be the primary reason for the creation of a conglomerate, tax incentives, they also essentially play a role. So to a large extent, these incentives, they can be found in the rules that essentially control the filing of consolidated returns. So in general terms, the IRS still allows certain corporate groups to be treated as a single entity for income tax purposes, and obviously there's certain rules and requirements that needs to be met. But on a large scale, this enables the group to use the available tax exemptions that optimal among its members and helps to shelter income of profitable members. So for example, let's say corporation A has $100,000 of income and corporation B has a $30,000 loss. They're able to now combine the effect of the $100,000 of income, absorb the $30,000 loss, and now as a group, they are paying taxes on $70,000 essentially. So with a consolidated tax return, corporate taxpayers have an opportunity to manage the combined tax liabilities of the members of the group. So in general, some of the reasons, as we see here, a merger, an acquisition, or another corporate combination. The answer for this would be yes. One of these might have occurred that triggered the availability of a consolidation election. B, a desire to gain tax or other financial advantages, including increased market share and common economies of scale. This would be yes as well. And then we see C, a structural change in the capital of a corporation due to regulatory requirements, competitive pressures, or economizing of operations. Of operations. So this would be yes. It's the econ words that get you. All right, so we move on to the next question. Here it states, indicate whether the following treatments are financial accounting or tax. So financial accounting rules, as we know, do not always match the tax treatment of transactions involving groups of affiliated U.S. corporations. So one thing we know is that both the U.S. financial accounting and tax rules, they use the term consolidation, but there is a slight difference between the two. On page 1 of Form 1120, we have what's called Schedule M3. And then this is where a consolidated group, they would need to reconcile their GAAP income, which is their book income, with the taxable income that's going to be reported on the consolidated tax return. So there are some nuances, and we need to ensure that these things are accounted for. So here we see A, included corporations, if they have consolidated financial statements that can include non-US corporations and non-corporate entities, this would be financial accounting. The consolidated tax returns can only include US corporations. This would be for tax purposes. Next, we see adjusting for intercompany transactions. The tax rules generally only require recognizing intercompany transactions that affect taxable income. This would be tax rule. GAAP requires adjusting for all intercompany transactions. This would be financial accounting. C, an acquirer that takes over its target organization. The transaction is treated as a purchase with cost amounts marked up or down to fair market value. This would be financial accounting. The deal is non-taxable with the carryover basis if the transaction is a qualifying reorganization or stock purchase. A taxable asset purchase results in a fair market value tax basis for purchased assets. This would be under tax rules. D, a purchase price that exceeds the sum of the net assets that have been acquired. So the difference is goodwill. Firms generally amortize purchased goodwill over 15 years. This is how it would be treated for tax purposes. Here we see the difference is goodwill, no scheduled amortization for public firms. Instead, they record impairments or restorations of goodwill on the income statement and balance sheet. Private firms can elect to amortize over 10 years or less and avoid impairment testing. This would be under financial accounting. Next, we move on to E. Greater than 50% ownership generally results in required consolidation. This would be under financial accounting. Under taxation, consolidation requires 80% or greater stock ownership. So this would be tax. So again, the main purpose for this question is to indicate how these different things, the included corporations adjusting for intercompany transactions, an acquirer taking over its target organization, a purchase price that exceeds the sum of net assets required, and what is the threshold for inclusion as it relates to ownership. So this is distinguishing between how it is treated for financial accounting, GAAP purposes versus tax purposes. So we move on to the next question. Here it asks us, considering only the requirements under federal income tax law that must be met before a parent and its affiliates can file its first consolidated return, complete the statements below that outline the requirements of the parent and its affiliates. Before a consolidation election can be made under tax law, the three major requirements that first must be met are, so as we learned going through the chapter, there's some key things that must be met. The first is there need to be an affiliated group status. The second is that they cannot be ineligible to file on a consolidated basis, so they must be an eligible corporation to join a consolidated group. And three, they must meet the initial test in the ongoing compliance requirements specified in the code and regulations. So therefore, the correct answer for the first question would be affiliated group status, eligible corporation to join the consolidated group, in addition to compliance requirements. So this would be the correct answer. But just to provide some, more background on what these requirements are. So an affiliated group exists when there's one corporation that owns at least 80% of the voting power and the stock value of another corporation. Keep in mind, the stock ownership test, it must be met on every day of the tax year. And if there's multiple tiers and chains of corporations, they are allowed, again, as long as the group has an identifiable parent corporation. And that identifiable parent corporation is when one corporation owns at least 80% of the voting power and stock value of another corporation for every day of the tax year. Eligible corporation to join consolidated groups. So the Internal Revenue Code lists a number of corporations that cannot use a consolidated return to report their taxable income. Thus, these types of corporations, they cannot be used to meet the stock ownership test. Hence, their taxable income can't be included in a consolidated return. So the corporation must be eligible to join a consolidated group. And lastly, as it relates to the compliance requirements, an eligible entity that meets the stock ownership test, they can be included in a consolidated group if several compliance requirements are met. The first consolidated tax return of an affiliated group, they have to meet those requirements. And once they do, we have what's called Form 1122-1122, and that form needs to be attached to the first consolidated tax return for each of the subsidiaries that are included in the group. So this form, it basically represents consent by all of the affiliates to be included in the consolidated group. So much like for an S corporation, when Form 2553 is filed, all of the members of the, let's say it's a multi-member LLC, all of the members of that multi-member LLC, they need to essentially sign off that they agree for this multi-member LLC to no longer be taxed as a partnership, but to be treated as an S corporation. So with this Form 11-2022, that needs to be filed. And then for the years after, each consolidated tax return has to include Form 851, affiliation schedule that, it's basically going to report or identify rather all of the corporations that's a part of that group. It'll summarize some of the pertinent information, such as the shareholders, the shareholdings, stock ownership changes, and it'll list any estimated tax payments, if any. So just going through this information again, just wanted to sum up those three things. So it says blank of the members of a corporate group must meet the requirements to be eligible to elect and maintain the right. So is it all, the majority, at least 80-50? All of the members of the corporate group, they have to meet the requirements and maintain the right to file a consolidated income tax return. Here we have a corporation can join in a consolidated tax return if it is a member of, as we pointed out, an affiliated group, both the 50%, 80%, or 100%. It is an 80% stock ownership test and the structure test of an identifiable parent and trustee, or trustee and identifiable parent. And again, the identifiable parent is a corporation that owns at least 80% of the voting power of the stock each day of the tax year. So we move on to the last part. Form 851, 1122, 1120. So Form 1122, as mentioned, should be attached to the first consolidated tax return for each of the subsidiaries included in the group. And this form represents a consent by the affiliate, by the affiliate, yes, not the parent. So all of those that are essentially under the parent to be included in the consolidated group. So again, before making an election to file this consolidated tax return, the related taxpayers, they need to take the time to really understand what are the pros and what are the cons of making this decision to file a consolidated tax return, because once the election is met, it would need to be revoked by the IRS. So it's just like getting married. You get married today, the next day you decided, or you think, hey, I made a really bad decision. It's not an easy process to get out of it. You need to go through divorce and all of these different things. The same thing with the consolidated tax return. Once that decision is made, it's not a difficult process, but it's a process to go through before that decision can be annulled or revoked. So here with this question, it asks us to classify each of the following scenarios: probably a good match, probably not a good match, no effect on consolidation, regarding consolidated return partners in computing the affiliated group's federal income tax. Consider federal income tax implications only. The pairing could still be favorable after considering non-tax advantages. So as just pointed out, Before a decision is made, the company, the corporations, they really need to determine, hey, does this make sense in the long run? So finding good consolidated return partner often means the contrary tax effects are matched. One of the key things is it going to result in lower federal income taxes. So just like with anything else in life, there are pros, there are cons. You want to make sure that there are more pros than cons. So for A, it states Subco has a number of appreciated assets that it wants to sell to its parent, Hugh Corporation. So, based on this is probably a good match. Why? Because intercompany gains, they are deferred, they're postponed, delayed until a sale is made to a taxpayer outside of the consolidated group. So in the event that there's not a consolidated tax return, and let's say Subco sells it to a huge corporation, Subco is going to need to record a gain on the sale. But if it's a consolidated, if it's an affiliate group, in such case, they'll get to defer it until it's sold to someone outside of the group. Next, we see Subco has a number of assets that it wants to sell to its parent, Huge. The assets have declined in market value since Subco purchased them. So, the first example, we had appreciated assets. And in this example, we have depreciated assets. So therefore, considering that, probably not a good match. Why? The parties, they'll want to accelerate recognition of realized losses. Consolidation, unfortunately, results in a deferral of these losses. C states parent co uses cost depletion in accounting for its natural resources, whereas subco wants to continue to claim percentage depletion. So doesn't have any effect on the consolidation. Reason being, the tax return elections that's made by the parent of a consolidated group, it can differ from those made by other members of the filing group for the tax year. Consequently, has no effect. So D states parent corporation uses a calendar tax year, whereas sub 2 has been used in a September 30th tax year. And based on that, probably not a good match. So sub 2, they are essentially the affiliate. And based on that, sub 2 is going to have to convert to a calendar tax year when they join parent company's consolidated group. And for the group, this might essentially result in bunching more than 12 months of taxable income into the calendar year of the election. So hence, this is probably not a good match. So we move on to the next question. And here it states, what are some of the entities that are ineligible to file a consolidated tax return? So as mentioned previously, the code lists a number of corporations that cannot use a consolidated return to report their income. Thus, these corporations can't be used to meet stock ownership tests, taxable income can't be included in a consolidated return. So some of the most frequently encountered entities that are deemed ineligible, this includes corporations that are established outside of the U.S. or in a U.S. possession, tax-exempt corporations, insurance companies, partnerships, trusts, limited liability entities, estates, non-corporate entities. So they are not eligible to join. So here we see we have Lima City Charcoal Artists Co-op. They would not be able to join. Why? Exempt entities, they are ineligible to join a consolidated group. We have Befeque Services Inc. Yes, this just seems to be a regular corporation. Here we have Tequila Telefono organized in El Salvador. Nope, they cannot be eligible to join a consolidated group. We have Vermont, South Carolina, and Utah Barbershops Inc. Seems to be a regular old corporation. Yes. We have Capital Management Partnership. No. As mentioned, non-corporate entities, they are ineligible to join a consolidated return. Next, we have Henry Perez Trust. This would also be a no. non-corporate entities are ineligible to join a consolidated group. So we move on here, all right? Again, some of the most frequently encountered entities that are ineligible: corporations established outside of the U.S., 2, tax-exempt corporations, 3, insurance companies, and 4, non-corporate entities. They are ineligible to file a consolidated tax return. So for this question, it's asking how much of Minnie's NOL can the Mucho Group use in computing its consolidated taxable income? It states Minnie Corporation bought a $7 million NOL carry forward into the Mucho Group of corporations that elected to file on a consolidated basis as of the beginning of this year. Combined results for the year generated 15 million taxable income, and 2 million of which was attributable to Minnie's activities for the year. Assume that Section 382 limitations do not apply. So the usual corporate net operating loss computations, they are available for the losses of a consolidated group. We know that there's been some changes with the Tax Cuts and Jobs Act, but for any tax years prior to 2018, those losses would be carried back 2 years, and then for 20 years. And although the parent could elect to forego to carry back deductions for the group, any losses that arise after 2017, they can't be carried back, only forward. But just keep in mind, those losses, they cannot reduce the taxable income by more than 80% in the year that the loss is applied. The NOL, the consolidated NOL rather, it's essentially derived after they remove any consolidated charitable contribution deductions, capital gain or loss, and things of that nature. So the reason why they're removed, because obviously they have their own carryover periods and rules. Whenever a consolidated group's deduction of the member's loss, it's limited to the member's current year or cumulative contribution to the consolidated income. So in this case, 2,000 of which was attributable to Minnie's activities for the year. So therefore, the net operating loss in such case is going to be limited. So due to the SRYLLY, right? So what this simply means is the separate return limitation year, right? So with the separate return limitation year, this is essentially, again, the entity's cumulative contribution to the consolidated taxable income. Why is this provision in place? Some corporations would take advantage. And again, Uncle Sam, don't play that. So with such case, only 2 million of Minnie's NOL carry forward can be used in the first tax year. However, limitations under Section 382 may further reduce that deduction. So something to keep in mind. But again, with this problem, it said assume 382 doesn't apply. But if it does, limitations under this rule may reduce the deduction. This brings us to our next question. So here it states, how is the gain from these transactions reflected in consolidated taxable income in year 3 and year 4? So it states an affiliated group incurs the following transactions. Year 1, Subco purchases a non-depreciable asset for $400. Year 3, Subco sells the asset to parent for $575. And year 4, parent sells the asset to stranger, not an affiliate, for $660. So as we pointed out earlier, whenever there's intercompany transaction, there's a special class of these intercompany transactions that receive deferral treatment under the regulations. So if there's a gain or if there's a loss that's realized on a transaction, it's removed from the consolidated taxable income until the sold asset leaves the affiliated group. So in such case, Subco purchased the property for $400. They sold it for $575. So there was a gain of $175. And here we see it was sold for $660. So the purpose of this rule, whereby there is a deferral of the gain and a deferral of the loss, this is based on the matching rule. So the goal of this is basically to prevent the group members from accelerating loss deductions that relate to the sale of assets within the group. So the matching rule, it applies to sale of assets or the performance of services among group members. And again, the entire deferred gain or loss, it enters the consolidated taxable income computation when the asset is transferred outside the group. And in this case, we see in year 4, it was sold to stranger. So based on this information, in year 3, we recognize nothing, right? We transferred it to the parent. So in year 3, nothing is going to be recognized. However, in year 4, we are going to recognize $260 worth of gain. So initially, 575 minus 400, we see that there's a $175 deferred gain. And then in addition, we sold it for $660 and the basis is $575. So there's an 85, let's just say, $85 gain. So $85 plus 175 is $260. Another way is basically just to factor in, okay, we sold it to the parent for $660 and it was originally purchased for $400. There's a $260 gain. All right. So initially, the $175 gain between parent company and subco, that $175 gain is deferred. And then the $85 gain when parent sells it to the affiliate is now added to the previously deferred gain. And 85 plus 175 gives us this 260. All right, so here we have this question. A asks, what is the group's consolidated taxable income and consolidated tax liability? And B states, if the parent group has consented to the relative taxable income method, how will the consolidated tax liability be allocated among the parent and subsidiaries 1, 2, and 3? So for this, we'll get an Excel ready. All right, so the most commonly used tax sharing agreements, we have what's called the relative taxable income method and the relative tax liability method. So under the relative taxable income method, the consolidated tax liability, it's allocated among the members based on their relative amounts of separate taxable income. And when the relative tax liability method is used, the consolidated tax liability is allocated based on a relative hypothetical separate tax liabilities of the members. The IRS permission, it is required for the group to change from one allocation method to another, but such permission is granted automatically for these and other common tax sharing methods. So in this case, we need to determine, all right, well, what's going on? So the first part of it is, under the relative taxable income method, what is the consolidated taxable income and what is the total consolidated tax liability? So we see that parent has income of 10,000, sub 1 has a loss of 1,500, sub 2 income of 4,000, sub 3 income of 2,000. So the taxable income in this case is the 10,000 minus the 1,500 plus 4,000 plus 2,000. So therefore, the taxable income in this case is 14,500. Now we need to determine what's the total consolidated tax liability. So we know that all corporations, as of the Tax Cuts and Jobs Act, they are subjected to a flat 21% tax liability. So therefore, 14,500 times 21%. Therefore, the tax liability, the total consolidated tax liability is 3,045, right? So fairly straightforward for the most part. Again, we just add up the total income for the parent and all of the subsidiaries. That gave us 14,500. The tax rate for corporations is a flat 21%. So we multiply that amount by the taxable income to give us our tax liability, right? So now we move on to the next step. And then for B is asking if the parent group has consented to the relative taxable income method, how will the consolidated tax liability be allocated among the parent and the subsidiaries 1, 2, and 3? So we know here the tax liability is 3,045, right? So we know that information, but now we ultimately need to determine how is it going to be accounted for. So here we see for parent, we already know, the income. We already did this, so we'll just, copy this down. But now we want to determine, okay, how is it going to be allocated? So in this case, sub 1, their loss, again, we're looking at the relative taxable income method. Sub 1 has no income. So therefore, that $1,500, this loss is not going to be subjected to tax. So we change this to 0, right? We're focusing on the relative taxable income method, and sub 1 has no tax. But parent, however, has taxable income of 10,000, sub 2, 4,000, and sub 3, 2,000. So there's a total of 16,000. So what we essentially need to do is to determine what is the proper allocation. And how do we determine that allocation? It would be as follows. So it'll be the separate income divided by total income, right? And that will help give us the pro rata amount. So for a parent, their separate income is 10,000. The total income is 16,000. So it'll be 62.5%. Oh, well, need to move this up. Perfect. For sub 1, their income is 0 divided by 16,000 gives us 0. For sub 2, 4,000 divided by 16,000 gives us 25%. And for sub 3, 2,000 divided by 16,000 gives us 12.5%. So now the next thing we need to do is we needed to calculate the separate income divided by the total income. So we calculated these amounts up above. So we know what the tax liability is. The tax liability is 3,045. So therefore, for parent company, it'll be the tax liability multiplied by the allocation of the separate taxable income divided by the total taxable income. So therefore, 1,903 $13 would be the allocated tax due. All right, and I think we will make this a bit easier or more better to understand. I'll copy this. Actually, all right, so That is how we calculated the allocated tax due. Again, it is the separate taxable income divided by the total income. Just want you guys to be very clear of how this was calculated. And this amount was calculated down here. So I'll also turn this in red so that way it's very clear how these amounts were calculated. And then the tax liability, which we calculated from up above, which is going to be green. And let me I'll remove this fill so that way there's no confusion. All right, so again, the separate taxable income divided by total income, we get the allocation percentages down below, and we multiply it by the tax liability, which we calculated previously. So therefore, for parent, the income or loss is going to be 1,903. For sub 1, they had no taxable income, so none of the tax liability would be allocated to them. For sub 2, we calculated the 4,000 divided by 16,000, which gave us 25%. We multiply that by the tax liability of 3,045. So therefore, 761 would be allocated to sub 2. For sub 3, 2,000 divided by 16,000 gave us 12.5%. So therefore, 12.5% multiplied by the tax liability of 3,045. If we round this, it'll give us $381. So once we round these down, we add them. This will give us 3,045. And as we see, based on the allocation method, 1,903 of the tax liability would be allocated to parent, 761 to sub 2, and 381 to sub 3. All right, so this brings us to our next question. And here it states, compute Clifton's stock basis in Gillian on the last day of each of the indicated tax years. Clifton Corporation acquired all of the outstanding Gillian stock on January 1st, year 1 for $2.4 million. The parties immediately elected to file consolidated federal income tax returns. Gillian reported a year 1 taxable loss of $250,000, but it generated $400,000 of taxable income in year 2 and $180,000 in year 3. Gillian paid a $100,000 dividend to Clifton in year 2 and a $300,000 dividend in year 3. So upon acquiring a subsidiary, the parent corporation, they're going to record a stock basis in the tax balance sheet that's equal to the acquisition price, right? So simply stated, what that means is that when we first purchased it, which was in year 1, we paid $2.4 million. So that's our beginning balance. So upon acquiring the subsidiary, they record the stock basis equal to the acquisition price. And at the end of every consolidated return year, the parent records one or more adjustments to the stock basis as in the financial accounting equity method. And this treatment prevents double taxation of gain or loss upon the disposition of the subsidiary shares. So there's some things that increase the basis and some things that decrease the basis. So if there is income for the year, that increases the basis. If there's an allocable share of consolidated operating or capital loss of a subsidiary that couldn't be utilized through a carryback, that would be added. Some things that decrease the basis would be an allocable share of consolidated taxable loss, an allocable share of any carryover operating or capital losses that are deducted on the return and has not previously reduced the stock basis. So in this case, these are some of the things that, again, either increase or decrease the basis. So now we look at what's going on in year 1. So year 1, we purchased it for $2.4 million. That is our beginning basis. And then we see in year 1, they had a loss of $250,000. So there was no income. There was no allocable share of consolidated operating or capital loss. We had a loss in this case, which was $250,000. There was no allocable share of any carryover operating or capital losses that were deducted. And there were no dividends. So therefore, the ending balance as of year one will be the sum of the beginning balance, the acquisition price. Okay. So it would be the beginning balance, which is the acquisition price, plus 0 minus 250,000. So the ending balance of year one will be 2,150,000. So one thing we know about accounting is the ending balance of the prior period becomes the beginning balance for the next period. So for year two, our beginning balance is 2,150,000. So now what's going on in year two? It says in year two, there was taxable income of 400,000. So we have a plus. It doesn't say anything about an allocable share of consolidated operating or capital loss that couldn't be utilized through a carryback of a loss. So that's 0. We had taxable income, not a loss. So this would be 0. It doesn't say anything about any allocable share of any carryover that is deducted on a consolidated return and not previously reduced. So this is 0. It does say that we paid $100,000 worth of dividends, however. So based on this information, the ending balance for year two will be calculated as follows. So it will be our beginning balance for year two, which was our ending balance for year one, plus the 400,000 of income, minus the 100,000 paid in dividends. Therefore, for year two, the ending balance is 2,450,000. So now we move on to year three. And again, the year two ending balance becomes the year three beginning balance. So in year three, it lets us know that we had taxable income of 180,000. Whoop, too many zeros. 180,000. It doesn't say anything about any allocable share of operating or capital loss that couldn't be utilized through carryback. So this is 0. We didn't have a loss. We had income. It doesn't say anything about carryover operating or capital losses that were deducted on a consolidated return and didn't reduce the basis, but it does say that we paid dividends in the amount of 300,000. So therefore, the ending balance for year three is our beginning balance for year three, which is our ending balance for year two, plus our net income minus the dividends paid of 300,000. So therefore, for year three, the ending balance is 2,330,000. So again, this is the key thing to keep in mind. Start off with the beginning balance. You add anything that increases the basis and subtract anything that decreases the basis. All right, so this brings us to our next problem. So here it asks, what is parent group's net operating loss for the year that is available to carry forward? It states parent and child corporations have filed on a consolidated basis since the mid-1990s. The group reports the following amounts for the current year. We have operating loss, including the following: 2.5 million. And this includes charitable contributions of 600,000, a net capital gain of 1.1 million, and dividends received deduction of 450,000. So as we pointed out, the usual corporate NOL, if it's before 2018, carried back 2 years, carried forward 20 years, right? After 2017, it cannot be carried back. It carries forward indefinitely But one of the key things is that the loss, it can't reduce taxable income by more than 80% in the year that the loss is applied. And the consolidated NOL, before we can determine the amount, it's derived after we remove any consolidated charitable contribution, deduction, and capital gain or loss from the consolidated taxable income. Any dividends received deduction remains in the NOL, because if we go back to the NOL rules, essentially, or if we go back rather to the dividends received deduction rules, there's a limitation with the dividends received deduction based on the taxable income before special deductions and the dividends received. However, whenever the dividends received deduction, if it creates an NOL, then that caveat, it's no longer in play. You get to take the full dividends received deduction if it creates an NOL. So in order for us to calculate that amount, we start off with the operating loss. We add back the charitable contributions of $600,000, and we subtract the net capital gain. And that lets us know our consolidated NOL. So based on this information, again, we start off with our operating loss, we add back the charitable contributions, and we subtract the net capital gain. So therefore, based on this information, the parent group's NOL that's available for carry forward is $2 million. All right, this brings us to our next question. Here it states for A, how much is parents' separate taxable income? B, how much is subco's separate taxable income? And C, how much is a consolidated taxable income? So specifically, there's certain items that are computed on a group basis with the usual C corporation tax effects that's going to be applied to a combined group amount. So this includes net capital gain or loss, charitable contributions, dividends received deductions, NOL, various tax credits and recapture amounts. So following the computational procedures, all of the group basis items, they're removed from each member's separate taxable income. And from there, we use the consolidated taxable income to figure to that point any statutory limitations that are going to be applied in order to determine the group basis gains, losses, income, as well as deductions. So computing these items on a group basis, it doesn't necessarily always result in a reduction of the aggregate group taxable income. Nevertheless, the possibility of using this group basis computation, it may ultimately affect the transactions by group members later in the year when it becomes apparent that if there's any tax planning opportunities available. So we'll start off with this information here. Parent corporation, they have current taxable income included $100,000 net income from operations, $10,000 net long-term capital gain. Parent also made a $5,000 charitable contribution. Subco generated $45,000 worth of income from operations and incurred a $2,000 net capital loss. So the first portion of the problem is asking, all right, well, what's the parent information? So the separate taxable income would be calculated as follows. $105,000. How do we calculate that? So 100,000 of net income plus $10,000. Sure, it's not too many zeros. Plus $10,000 of net long-term capital gain minus $5,000 of charitable contribution. So therefore, the separate taxable income for parent corporation is 105. Again, how do we get that? 100,000 of net income from operations plus the net long-term capital gain of 10,000 minus the $5,000 charitable contribution. That is how we calculate 105,000 for the separate taxable income. But again, we need to make some adjustments. So we need to adjust for the $10,000 capital gain. And as we saw in the previous problem, the capital gain is going to be subtracted, and we need to add back the $5,000 charitable contribution. All right, so based on this information, how do we determine the post-adjustment amounts? We're going to account for, let's see if the summing works. We're going to account for the separate income, adding back or subtracting rather the capital gain and adding back the charitable contribution. So therefore, the post-adjustment amount in this case would be $100,000. But just keep in mind for A, this is what it's asking. Oops, daisy. All right, so for question A, the correct answer is 105,000. And now the next part of the question is asking, how much is subco's separate taxable income? So based on the information for subco, it lets us know that the separate taxable income is 45,000. Then it asks us if there's any group basis transactions, nothing in the problem. If there's any intercompany events. All right, so the next thing we need to factor in is for the group basis transactions. All right, so here it's going to be 0, 0, but now we need to factor out as far as the adjustments, right? So we see that parent company has a $10,000 capital gain, and then we also see that there is a $2,000 short-term capital loss from sub. So we need to factor in, considering the consolidated group can use the $2,000 capital loss to offset a part of the $10,000 gain. So therefore, the net effect is going to be 8,000, right? Again, $10,000 minus the 2,000. Oh, got the right sum. So equals, all right? So keep in mind, here we're looking at the parent, but now we are looking at subco. So for subco, they factor in, this was capital gain income. And then now for the subsidiary, we are factoring in the net long-term capital gain, which is 8,000. And then for subco, based on the group basis transactions, let me shift this down actually. Shift this down one more since we're looking at the group. Gotta shift this down one more. Perfect. All right. So we're looking at it from the group basis. So we have the $8,000 again. How do we get that? The 10,000 that essentially offsets the 45,000, or offsets rather, sorry, the 10,000 capital gain income. So again, 10,000 from parent corporation, subsidiary has a $2,000 loss. So 10,000 minus 2,000 is 8,000. And then we have the $5,000 that can be offset for the charitable contribution. So we're looking at it now from a group basis. We wrap text this. So for B, we already know subcode 45,000. And then now for C, it's asking us how much is the consolidated taxable income. So we get the post adjustment amount for parent corporation. They started off with $105,000 of separate taxable income. How do we determine that? It is $100,000 of net income plus $10,000 of net long-term capital gain minus $5,000, which gives a separate taxable income of $105,000. From there, we need to make adjustments. We subtract the capital gain income and we add back the charitable contribution. So therefore, the post adjustment amount, the separate taxable income again was 105, but the post adjustment amount was 100,000. For sub corporation, they had $45,000 income from operations. That represents their separate taxable income. But now on a group basis, we see that on the group basis, we need to account for the net between the $8,000. And how is this $8,000 calculated? The $10,000 net long-term capital gain from the parent, which is offset by the $2,000 short-term capital loss, which is how we calculated $8,000, offset by the $5,000. So therefore, the net between these two is $3,000. There were no intercompany events. So therefore, the consolidated taxable income, which question C is asking us for, is the $100,000, which is the post adjustment amount for parent company, $45,000, which is the post adjustment amount for the sub company, and the $3,000, which is based on the group basis transactions. So therefore, the consolidated taxable income, I don't know why this is not going. There we go. Is $148,000. All right, so again, we start off with the separate taxable income, account for any adjustments both at the parent level, subsidiary level, the group basis transactions, and intercompany events. And that is how we calculate the consolidated taxable income. All right, this brings us to our next question. So here for this question, we see it asks your client, big corporation, and its wholly owned subsidiary, Little Co., file a consolidated return for federal income tax expense, indicate the treatment on financial accounting income and taxable income for the following intercompany transactions by selecting gain income, loss expense, or no effect. So Little Co. Little Co pays a $1 million dividend to Big. So under financial accounting treatment, this would have no effect. Why? It's a consolidated eliminated entry, has no effect on the book income. If it were a consolidated return treatment, it'd be the same thing. Consolidated eliminating entry, there will be no effect on the taxable income. So the tax return amount for Big Co, 0. Tax return amount for Little Co, 0. Next, we see Little Co sells investment land to Big Little Co, book value and basis in the land of $200,000. There's a selling price of $600,000. So this would have no effect. Why? The consolidating eliminating entry is going to defer the $400,000 gain. Same thing under the consolidated tax return treatment, no effect. 0 is recognized for big corporation and 0 for little corporation. So now here is saying 6 months after purchasing the land from Little Co, Big Co sells the investment to Phillips, an unrelated party, for $750,000. So this is going to have an impact, right? The basis was 200,000 and it's now being sold for 750. So we have a gain for financial accounting purposes. Big is going to have to report how much in gain. So we'll calculate it here. What was the intercompany gain? The intercompany gain, as we see here, the sale price was 600,000. The basis was 200,000. So there's a $400,000 intercompany gain. In addition, we paid 600,000 for it and we sold it for 750. So in addition, there's a $150,000 gain. But we see that it is going to be, for financial accounting purposes, big company would report $550,000. But we need to figure out how much is big company going to recognize and how much is little going to recognize, because it's obviously going to be allocated between both. So in such case, under the tax return treatment, there is going to be gain income. Now, for big corporation, for them, they're going to have to recognize a $150,000 gain. How do we determine that amount? Oops, sorry about that. How do we determine that amount? It is ultimately, we sold it for 750,000. We purchased it for 600,000. So therefore, they recognize a $150,000 gain. Now, little company rather, on the other hand, they sold it for 600,000. The basis was 200,000. So therefore, they would recognize a $400,000 gain. Again, so that's the key thing with the intercompany transaction. The gain is deferred until it is sold to a third party. So B, it was an intercompany transaction. C, it was sold to a third party. Hence, the gain is now recognized. All right. So this brings us to our next question, similar to one we saw before. So here it is asking us to determine seniors' basis in junior co-stock as of the end of years 1, 2, and 3. So here it states, Senior Ltd acquires all of the stock of junior company for $30 million at the beginning of year 1. The group immediately elects to file income tax returns on a consolidated basis. Senior's operations generate a $50 million profit every year. In year 2, Junior Co. pays its parent a $9 million dividend. Operating results for Junior Co. are as follows. In year 1, there's taxable income of $4 million. Year 2, $12 million. Year 3, $16 million. So the amounts would be calculated as follows. So here it states, the acquisition price is going to be the beginning balance. They acquired it at the beginning of year 1 for $30 million. Missing a 0, so $30 million. So now we move on and we would add any allocable share of taxable income. We will also add the consolidated operating or capital loss of a subsidiary that they couldn't utilize during a year. We didn't have any of this. This would be 0. However, we did have income in year 1. There's income of $4 million. There was no loss, nothing about losses that were deducted on a consolidated return, nothing about dividends. So therefore, the ending balance for year 1 is the beginning balance, the acquisition price of $30 million plus the $4 million of income. So the ending balance is $34 million for year 1. So as we know, the ending balance for the previous year becomes the beginning balance for the next year. So therefore, this $34 million balance becomes the beginning balance for the next year. So year 2 beginning balance is year 1 ending balance. Now it lets us know that for year 2, we had income of $12 million. Doesn't say anything about losses that couldn't be utilized due to carryback. We don't have a loss. We have taxable income. We didn't have any losses that were deducted on a consolidated return and didn't reduce the basis. However, it does say that dividends were paid, and in such case, dividends of $9 million. So for year 2, to get our ending balance, our beginning balance of $34 million, which was our ending balance for year 1, we add the taxable income for the year. We subtracted $9 million in dividends, so the ending balance is $37 million. So for year 3, our beginning balance is equal to our year 2 ending balance is $37 million. And this year lets us know we had $16 million of income. Doesn't tell us anything about losses that we couldn't utilize through a carryback. We don't have a loss. We had income. Nothing about losses that were deducted on a consolidated return. Nothing about dividends. So therefore, the ending balance for year 3 is the beginning balance plus the income. So therefore, the ending balance for year 3 is $53 million. All right, so this is going to bring us to our last question in chapter 8, which covers consolidated tax returns. So here we see, compute the group members' separate taxable income in the group's consolidated taxable income or loss. B says, same as part A, except that 5 years later, Subco sold the land to outsider corporation. And then for C, it's asking if we use a combined state and federal income tax rate, compute the time value of money benefit if the group defers the gain on the sale of land. So here it states, big corporations sold a plot of undeveloped land to sub company this year for $100,000. Big had acquired the land several years ago for $40,000. The consolidated return also reflects the operating results of the parties. BIG generated $130,000 of income from the operations, exclusive of the sale of land, and Subco produced a $20,000 operating loss. All right, so we need to determine these amounts. So for A, we figure the amounts as follows. So one thing we know is we need to factor in the matching rule. So for big, here we see they sold a plot of land for $100,000. They purchased it several years ago for $40,000. And then in addition, they also generated $130,000 of income. So based on this, you're factoring in two things: $130,000 of income, plus, again, we sold the land for $100,000. And we purchased it for $40,000. So based on this information, we had a $60,000 gain. Again, we are first and foremost starting off with this separate taxable income. All right, we need space, and this is similar to the question that we saw before. So separate taxable income. Then we account for adjustments. All right, so 190,000. Again, how do we calculate that? Big sold the property for 100,000. The basis was 40, so 100,000 minus 40,000 is 60,000 plus the $130,000 worth of income. For Subco, it lets us know that they had a Too many zeros, had a $20,000 loss. All right, so we can factor in the first set of information. Big has a $190,000 taxable income. Subco has a $20,000 loss. And then now we need to determine the consolidated income. So no adjustments for Big, 190,000. $190,000 Subco at the $20,000. And now we need to think of it. There were no group basis transactions, so no capital gains like we saw in the previous problem. But what we do need to factor in is the intercompany event. So there was a sale that took place. $100,000 is how much we sold it for. And the basis was $40,000. So therefore, there's a $60,000 gain on the intercompany sale. Right? So we factor that in. And again, this amount was deferred. Oops. All right. So this $60,000 again is deferred. So therefore, the consolidated taxable income accounts for the $190,000 of income for Big information, the $20,000 of Subco, and again, because the $60,000 is included in Big's separate taxable income, we're now backing it out because that gain is deferred. So therefore, the consolidated taxable income in scenario A is $110,000. So now we move on to scenario B. So scenario B is saying same as part A, except that 5 years later, Subco sold the land to Outsider Corporation for $130,000 when its operating income totaled $20,000, exclusive of sale of the land, and Big Co's operating income amounted to $90,000. So based on this information, now 5 years later, so here it shows us that we had Big operating income was 90,000. So all right, we see 90,000, which represents Big's separate taxable income. Let me copy this. All right, so for Big, $90,000. And then now we need to factor in for Subco. So except that 5 years later, Subco sold the land to Outsider for $130,000. So they had $20,000. Subco had $20,000 of taxable income. And then from there, we need to determine, well, what is the sale on the land? How are we going to determine it? Here's the basis of 100,000. How much it was sold for. So Big Co sold the lot to Subco for 100,000. So Subco's basis in the land is $100,000. And how much did they sell it for? 130,000. So 130,000 minus the basis, how much it was sold to Subco for by parent. So therefore, the separate taxable income for Subco is $50,000. Again, $20,000 from operations, and they had a $30,000 gain on the sale of land. They sold it for 130,000. They purchased it from Big Corporation for 100,000. So no adjustments to account for. For Big, no post adjustments to account for by Sub. No group basis transactions. So we have 0, 0, 0, but there was an intercompany event. We essentially need to restore. So remember, there was this $60,000 gain that was deferred. Now we need to factor in this $60,000 now needs to be recognized. So restore / recognize $60,000 deferred gain. Because again, the intercompany sales, they are deferred until it's sold to a third party, as just happened in year 5. So therefore, the consolidated taxable income in this case is going to be $200,000. So Big's taxable income, $90,000. Sub companies, taxable income, $50,000, which is a $20,000, plus the gain of $30,000. They sold it for $130,000. They purchased it from Big for $100,000, and the consolidated income, as we just factored in, is $200,000, which also takes into account the $60,000 worth of income that was deferred. So now this brings us to part C, and it's asking us, using a 25% combined state and federal income tax rate, compute the time value of money benefit to the group of deferring the gain on the sale of land. The Big group uses a 4% after-tax internal rate of return for the purpose of this analysis. The present value at 4% for 5 years is 0.8219. So we'll determine the present value as such. So the deferred gain, as we know, based on what we see here, Big sold it for $100,000. Big had a basis of $40,000, so $100,000 sales price minus the basis. There was a $60,000 deferred gain. And the tax rate, as it lets us know, was 25%. So therefore, the tax liability would have been $60,000 times the tax liability of 25%. Now we need to factor in the present value factor. So it gives us the present value factor. We don't need to use the present value tables. They give us the information. So it is 0.8219. So the present value on the tax of sale will be calculated as follows. The deferred gain multiplied by the tax rate, which is 25%, gives us $15,000. We multiply the tax liability by the present value factor, which is given. So the present value on the tax of the sale will be $12,329. So based on this information, the present value will be $12,329. So now it's asking us, what is the net benefit? So how do we determine the net benefit? The tax liability, if accounted for in year 1, sorry, it was 15,000. I'll just actually copy it. So it'll be 15,000 less the tax liability in year 5, which is based on a present value factor, which is 12,329. So therefore, the net tax benefit will be the tax liability from year 1 minus the tax liability from year 5. So therefore, the net benefit will be $2,600 and 71. I don't know why this is giving me. Yeah, this should be 2,671. I guess it probably has something to do with the rounding. Oh, it's like right on the money, 50 cents. So 2,671, right? So this brings us to the end of chapter 8, which focuses on consolidated tax returns. I know there was a lot going on in this chapter. Nonetheless, again, there's some key things to keep in mind. There's 3 requirements to determine if corporations are eligible to file a consolidated tax return. Definitely corporations want to make sure that they understand the pros and cons before they even make such a decision. So again, this is the end of covering several questions for Chapter 8, Consolidated Tax Returns.